Investing fundamentals in the stock market. Sabri vlog. Investing in the stock market requires a solid understanding of investing fundamentals. Here are key investing fundamentals to consider. 1. Risk and return. Understand the relationship between risk and return. Generally, higher returns are associated with higher levels of risk. Assess your risk tolerance and investment goals to determine the appropriate balance between risk and potential returns. 2. Time horizon and investment goals. Determine your investment time horizon. Clarify whether your investment goals are short-term, less than 3 years, medium-term, 3 to 10 years, or long-term, 10 years or more. Your time horizon influences the investment strategies and asset allocation you choose. 3. Asset allocation and diversification. Asset allocation. Decide how to distribute your investment portfolio among different asset classes, such as stocks, bonds, cash, and alternative investments. Asset allocation helps manage risk and optimize returns based on your risk tolerance and goals. Diversification. Spread your investments across different stocks, sectors, industries, and geographic regions. Diversification reduces the impact of poor performance from a single investment and helps balance risk. 4. Market cycles and volatility. Understand market cycles. Markets go through periods of expansion, peak, contraction, and trough. Familiarize yourself with the characteristics of each phase and consider how it may affect your investment decisions. Volatility. Stock markets can experience short-term price fluctuations. Recognize that volatility is a normal part of investing and maintain a long-term perspective to ride out market volatility. 5. Dollar cost averaging vs. lump sum investing. Dollar cost averaging. Invest a fixed amount of money at regular intervals, example monthly, regardless of market conditions. This approach helps mitigate the impact of market fluctuations by buying more shares when prices are low and fewer shares when prices are high. Lump sum investing. Invest a larger sum of money in a single transaction. This strategy may be suitable if you have a longer time horizon and are confident about the investment opportunity. 6. Fundamental analysis. Learn fundamental analysis. Analyze a company's financial statements, evaluate its competitive position, and assess its growth potential. Consider factors like revenue, earnings, debt levels, profit margins, and industry trends to make informed investment decisions. 7. Technical analysis. Familiarize yourself with technical analysis. Study stock price charts, trends, and indicators to identify patterns and potential entry or exit points. Technical analysis can help you understand market sentiment and make short-term trading decisions. 8. Regular portfolio review. Monitor your investments, regularly review your portfolio's performance and make adjustments as needed. Rebalance your portfolio periodically to ensure it aligns with your asset allocation targets. 9. Emotional management. Control emotions. Emotions like fear and greed can influence investment decisions. Develop emotional discipline and avoid making impulsive moves based on short-term market fluctuations. Stick to your investment plan and long-term goals.
Thank you for your joining us. Please subscribe, like, and follow our social media channel. If you feel this information will be useful to you or someone else, please share this video. Comments with your thoughts and questions.